Hello, listeners. Welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. Joining me for our usually weekly chat, and we recorded a little later than usual, is Rob Larity, our chief investment officer. It's a good rundown of what's going on in geopolitics and markets. I've been all over the place this week. I was in North Dakota on Wednesday, Dallas Thursday, Friday for an event. Next week, I'm in Minneapolis at AgriGrowth. So the podcast schedule's been a little off. We're still keeping the cadence up, but like I said, this usually comes out first thing in the morning on Fridays. We had to push it back a little bit. We're squeezing things in as we go, but we have some good content coming in the next couple of weeks. You can email me at jacob@cognitive.investments if you have any questions about the research or wealth management services we provide, or you just want to talk about the podcast or recommend guests. And otherwise, that's all from me. Cheers and see you out there. Enough that I'm up at 6:55 in the morning recording already. What an impressive amount of work that I have here. But hey, at least I'm not Sam Bankman-Fried. How's it going, Rob?
It's going well, Jacob. I don't think people can see you, but if they could, they would realize that you're a dedicated man to bring them their content hot and fresh in the morning. Because you look tired.
I'm surprised at how nice I look I thought I looked nice. Okay. Oh well. You don't have your normal background with the architects making noise in the background. I see a pretty French painting or something, or some crown molding or something. Well, it's nice.
Yeah, I'm working from home today. I have my French lesson immediately after this with the novelist who lives below us. So I have to grab him and go grab a cafe table. I'm very Parisian, right?
Excusez-moi. I don't want to traipse on your lessons with your French novelist. Let's get started. I'm recording from Dallas. We're actually recording Friday morning. We usually record on Thursdays and put this out, but we are recording Friday morning, and we'll get this out as quickly as possible just because I've been on the road so much this week. But there's a ton going on this week. And why don't we start sort of as usual with the Fed statement from Jerome Powell, because I've been getting questions about that almost nonstop in the last 24 hours. So I assume you are too, and I assume the listeners are maybe interested in it. And then we can move on to some of the other interesting things happening in the world. But what did Jerome say, and why was it so important, Rob?
Well, it wasn't nearly as important as most people are assuming, because the headline was, the Fed is done raising rates. And if you just read the headline and you saw what the market did, then you assumed that was the story. I think the reality, as usual, is a little more nuanced. And as usual, you should actually read what the guy says instead of just looking at the Bloomberg flashing red ticker. But the market had been oversold and sort of in the hole and looking for a reason to rally anyway. And I think that was a big part of, making this into a big deal. But it is kind of ironic and interesting what he said, because, as we've been talking about, the Fed is in sort of an interesting position here, because there's sort of, if you really read their speeches and what they're saying in public and saying within the academic community, there's sort of this growing understanding that the monetary policy mechanism isn't quite working like they thought it would. It hasn't slowed down the economy like they thought it would. And there's this growing recognition that maybe the neutral rate of interest, so in other words, how high do you have to raise rates to really slow down the economy, that maybe that neutral rate is rising, and it's higher than it was a few years ago. And against the background of that, you're seeing more kind of hawkish talk. So that's what was happening heading into this. The other issue, as we talked about, term premiums in the last two podcasts. So term premiums are basically, how much are longer term bond yields going up to reflect uncertainty in addition to the expected rate path and that sort of thing. So that said, going into this meeting, that was the background. And what Powell said in this meeting was they left rates unchanged, and they said not too much different from what they've said previously, but the important thing was they said financial conditions have tightened because bond yields have gone up. So it's so funny how reflexive all of this is, right? Because people recognized that the Fed was not going to cut rates, and then bond yields went up, and then that tightened policy for them. So now they think the Fed is going to cut rates. So it's really hard to explain verbally, but it's like a knot of logic. So So the Fed acknowledged that, and they said, hey, bond yields have come up. Financial conditions are tightening as a result. And so we don't think we need to raise rates. But, and this is where the headline versus the actual, substance comes in. Here's what Jay Powell said, because he prefaced all of this and he said, but we're looking for persistent changes that are material. He said longer-term rates have moved up, but they can't simply be a reflection of expected policy moves from us, that we would then, if we didn't follow through on them, the rates would come back down again. So basically what he's saying is we can't come out and say this and have you think that we're going to not raise rates and then have the rates go down, because that eliminates the rate rise in the first place. And of course, that's exactly what happened. So the 10-year bond yields went from 5% down to 4.67% as we record this. And a lot of that increase has backtracked, and a lot of what the Fed a few days ago was citing as a reason not to raise rates is no longer valid. So, man, it's a lot to wrap your head around, but that is markets. It's a mirror, pointing at another mirror, just endlessly repeated. But that's where we are today.
What a thankless task Jerome Powell has. He has to try and get around all these different things, and then he has to wake up to guys like us, saying, "Oh, what a ridiculous thing that he's done." I guess the operative question though is, so I don't think and correct me if I'm wrong, I don't think we think they are done, nor do I think we think that the CPI is done. And there are plenty of realistic scenarios where you could see another uptick in prices from here. We're recording here Friday morning. It's still sort of up in the air whether the Israel-Gaza war is going to escalate into something more broadly, but crude is just sitting at 83. You can imagine a world in which we get some pretty large increases in CPI, and then you've got the Fed staring at itself with higher rates and yields going all over the place, but prices are still high. So is this as high as it is going to get from the Fed? Do you believe Jerome, or do you think he's going to be backed into having to raise again?
Our sort of baseline expectation remains that rates are likely to go higher from here. And there's ways that could not turn out to be the case, and we're considering those. But again, when you look at the big levers of the global economy, the one thing that has changed, as we talked about last time, is there's signs of weakness in commercial construction. So in the last week, Vulcan Materials reported their earnings. They make aggregates, and they noted a slowdown in warehouse construction, or the backlog of warehouse construction. That's been a major driver in the U.S. Companies like Nucor Steel have come out and said, hey, our backlogs are softening. So there's evidence that the rising rates are starting to bite that commercial construction and industrial construction sector, which has been just on fire. And that's the biggest bear point, I think. But at the same time, I think it's, at least in the near term, it's more than outweighed by the fact that, number one, the inventory cycle in the U.S. has been depressed, as we talk about almost every week, but there's more and more signs that that's rebounding. So the Port of Long Beach last month recorded its biggest month or year-over-year growth for quite a long time in this inventory cycle. Intermodal train car volumes, which are the train cars, where you take the container directly off the ship and drop it on the train. That's an intermodal train car. Those volumes have started to spike on a year-over-year basis. So there's signs that this is turning around. The freight cycle in trucking is starting to harden. So the prices are hardening, and truckers are locking in longer-term rates at a higher rate than spot. Anyway, without going into all the nitty-gritty, the inventory cycle has been in the dumps, and the manufacturing cycle in the U.S. has been in the dumps, and that looks like it's bottoming and coming out the other side. So durable goods have been on sale, have been weak for the 18 months, and that has helped compress inflation. If that should turn around, then that's only going to add fuel to the fire, because a lot of these so-called supercore inflation drivers haven't slowed down that much. So that's within the U.S. And then the other thing to keep an eye on is Europe has just been in a real deep slowdown from an industrial and manufacturing standpoint. And so if you look at the German zoo, I don't know if that's how we pronounce it, ZEW, economic outlook survey, that had been in the dumps as well, and that's starting to turn around. So that suggests that some big German companies are seeing a light at the end of the tunnel, and maybe we're bottoming there. So there's a lot of moving parts, in other words, but the notion that things are just going to remain static, I don't think, no matter what happens, it's not going to be that. And it doesn't seem like many people are really taking seriously the idea that we might have just gone through a cyclical slowdown and now we're starting a cyclical rebound. And if that were to happen, then I think it would be a shock, and expectations and yields would reflect that shock. So you want to be cautious about that.
Yeah, I mean, to put some meat on that, and I mean, this is a small sample size, although I've been in two very different places over the last 2 days with two very different audiences. The consensus view is definitely things are going to stay where they are right now. It feels like everybody's like, oh, we've gotten high enough, like now we're just going to get used to this. And I don't know, I'm with you. I don't quite see that. Speaking of major changes that happen while everybody expects things to stay the same, what a brilliant, elegant segue that was. Let's talk about some developments in the semiconductor space and maybe tie them back to Korea and Japan. Listeners have heard me probably talk before about how one of the things you have to do when you're doing research on geopolitics, on innovation and disruption, on investment, is you really have to keep your finger on the pulse of technological developments. And to do that, you probably need people in your back pocket who can tell you when something is happening that is changing, or at least can explain it to you in layman's English, which is why we have our CI Innovation Advisory Board and all these other things. But this week is a good example of some of that happening. So you had Canon, the old camera maker. They're coming out and debuting something called nano imprint technology for making semiconductors. It's a way to try and displace ultraviolet lithography equipment to create pretty cutting-edge semiconductors when you look down at what they're talking about announcing. There was also in Nature, China announced, or some Chinese Academy of something or other, announced that they were debuting something or testing something called an all-analog chip combining electronics and light. And basically, it's a light-based semiconductor, and it uses photons for computing and transmitting information. I'm sure we're going to get some of the details wrong because we are not semiconductor experts. And yes, we can read a few papers and stay not at a Holiday Inn, but I stayed at a hotel that felt like a Holiday Inn yesterday. So I'm feeling quite expert on all things in the universe. But these are just two major things that could fundamentally change semiconductor manufacturing if one of them takes off. And I know you wanted to talk about it from the point of view of ASML, so I'll let you jump in there. But the first thing I would just say is that when you're in this space, you need to be reading Nature, and you need to be reading all the things that are happening, and you even have to be willing to embarrass yourself and like try and start talking about it, even though you're not an expert in this stuff, because we're at the very beginning of trying to understand, well, is this actually going to challenge current semiconductor production? What will that do for which companies? And you can't be afraid of feeling like you don't know what you're talking about, because probably unless you're the scientist that were on the paper, or unless you're in Canon itself, probably nobody knows what you're talking about. So I'll leave it to you there to sort of set up why you wanted to talk about ASML in that context. But I think it's also an important methodological point to be reading not just the headlines in the newspapers and not just what's happening with the wars, but reading the press releases of companies that are announcing new products, or reading Nature to figure out what new things are happening from a scientific or technological disruption perspective.
I think it's worth talking about ASML and just about monopolies more generally in the context of innovation, because ASML is in essentially every international equity portfolio in the world. If anyone has an IFA or an ex-US International Equities Index, I guarantee probably your biggest position is ASML. Throw in some Nestle, ASML, call it a day. That's usually how it works.
Oh, and we have to throw in some TSMC too.
Oh, TSMC, I forgot. So those are the two biggies. And I think that's really dangerous. And we haven't talked about this on the podcast, I don't think, but we've talked about it with clients, because we're rolling out, we've been preparing for this for quite a long time, but we're finally rolling out our CI innovation strategy, which is a long-term equity strategy, and it's global. And that's going to be at the start of next year for our clients. And we've been doing a lot of prep for this. And in having sort of the preparatory discussions, we have a lot of people who have been saying, "Oh yeah, so you're going to have ASML in there, right?" Because and we say, "No, we don't like ASML," and that seems to raise a lot of eyebrows. And I think it's worth talking about this publicly in light of this news, because ASML it trades at 10 times sales, which for a capital equipment provider is very, very rich. And it's sort of the default option. So they have a monopoly, everyone knows that, on EUV lithography equipment, which is the highest, most advanced form. And I think the disconnect on ASML is that you can't see what's going to hurt them. I can't see what's going to hurt them. And I don't think this Canon announcement is necessarily going to hurt them. From what you can see, it looks like, it's not expected to have a significant impact on ASML per se. It's probably going to be used more for memory chip applications. The nano imprint tech that Canon is rolling out is a much simpler and cheaper way to do a lot of this, but it can't really handle some of the very high-end applications. So I'm not talking about Canon, but I'm just talking about the unknown unknowns, to use a Rumsfeldian, phrase. And
it's too early in the morning for Donald Rumsfeld, Rob. I don't know if I can stomach that right this second.
He's a 2 cup of coffee kind of guy, that's for sure.
Like a shot of bourbon kind of guy. Jesus.
But the thing about ASML is, especially around innovation, I think when you think about monopolies are so cozy because every investor loves monopolies. They love the moat. It makes them feel like Warren Buffett. Oh, these guys will never get displaced. Look at how complicated they have, mirrors, and just to make the mirrors, you have like 17 different companies and hundreds of millions of dollars and blah, blah, and the argument is obvious. But at the same time, I think if you sort of take a base rate approach and be like, okay, well, how many monopolies that were based on technology, not based on a geographic position, not based on some weird law, not based on some distribution dominance that is just impossible to replicate because of scale, based on technology, how many monopolies like that have persisted over time? And I think it's hard to really think of examples of ones that have. And one historical example I think is worth thinking about is NASA and SpaceX, right? I kind of think of ASML like the NASA of semiconductors. Like 25 years ago, no one would have ever thought that someone could create an alternative to NASA. NASA had the biggest budget. They had all the intellectual capital, all the scientists. The amount of money that they spend on any given project was in the billions of dollars. The amount of sophistication and intellectual heft that they brought to everything was just enormous. And yet, SpaceX were here 20 years later, and on a relative shoestring budget, they found ways that were kind of previously unthinkable to navigate around that and to emerge and basically make NASA look like a dinosaur. So I don't know who that company is for ASML, but I think the Canon news, which sort of came out of nowhere, I think it shows you that when the stakes are this high and it's a matter of innovation and new technology development or new technology creation, it's very difficult. I think that risk reward is almost always bad to bet on that monopoly persisting, because you're betting on the unknown unknowns never rearing their head. And I think, the base rates would argue against you in that way.
Well, and I think ASML and TSMC, which is Taiwan Semiconductor for those who maybe aren't used to the tickers, in some ways, they're both, I refer to them often as the platonic ideal of globalization. And the semiconductor supply chain was in some ways the platonic ideal of globalization, because you had hyper specialization in relatively small countries like the Netherlands and Taiwan we're talking about respectively right now for such critical parts of the semiconductor supply chain. And today, no country can make a supply chain from scratch by itself. It just doesn't work. You have such specialization from all these different countries that it has to be a global supply chain working in concert. And this is where the US-China trade war and geopolitics really comes in, because when the United States went after China in the way that it did and made semiconductors such a central part of its fight against Huawei at the time and now against other Chinese companies, they basically said, all right, well, globalization doesn't work for semiconductor supply chains anymore. So now you have the Chinese government and Chinese researchers and Chinese companies furiously trying to figure out how they can do things without ASML technology, because the United States is leaning on the Netherlands to force ASML not to sell to China in general. You've got Japan, which is also critically exposed to all of this. Obviously, Japanese companies thinking about alternative ways to go about producing semiconductors. So there's a wave of research and disruption that is trying to respond to the bottlenecks that have cropped up in both Taiwan and the Netherlands. I think the one thing I would say is, we're not saying, and I don't think you're saying this, but just to be clear about it, like, we're not saying ASML is going to collapse or anything like that. If you want stability in a portfolio, ASML might be a good company, because this disruption is not going to happen in the next 2 years or 4 years or maybe even 7 to 10 years. It might take that long for the disruption to happen. But that innovation strategy you talked about, it's designed to maximize growth over a 5 to 10 year time horizon. And the thing that you're doing there is you're looking for the next ASMLs. You don't want the monopoly that is already there that really doesn't have to do anything to continue, dominance in its own space, which is the position that ASML is in. And congratulations to them, and congratulations to anybody who figured out 10 years ago was the time to buy ASML. But to your point, now is the time to find, okay, well, what is the other 4-letter acronym in some random country that nobody's talking about that is going to power the next 10 years of growth, rather than the one you can go to the dinner party and say, oh, look, like the chart looks like sort of great. So it's not that ASML is bad or anything like that. I just think when you combine the geopolitics plus the market forces against a monopoly built in like that, that's why we're saying we're looking further afield for those other opportunities.
Yeah, it's not bad. And, we're not saying it's going to collapse, of course. But we're not going to own it for our clients. Not at 10 times revenues.
No, and not in that strategy. We also, we put out a report for our clients on TSMC earlier this year, which looked pretty good in retrospect. But I'm not going to give us any pats on the back there. Let's move on to the place where I actually wanted to give ourselves some pats on the back, which is Ford announced some pretty grim, they were trying not to make it grim, but some pretty grim things about electric vehicle demand. They withdrew their 2023 forecast, although some of that had to do with the pending deal with the UAW union for their workers, but they're also delaying up to about $12 billion in planned investments on electric vehicles, including construction on a major, I believe it's a second major battery plant. They acknowledge that they've had EV sales have grown for them, but consumers don't seem to be willing to pay a premium over a gas or hybrid vehicle, and their profits have been squeezed. They recorded a $1.3 billion loss in Q3 on their Model E unit. So, it looks like electric vehicles is not actually profitable for them at this point. So we've talked about electric vehicles here before and talked about how skeptical we are in the podcast, but here is Ford coming out and saying it. And listeners probably know that Tesla has been slashing prices left and right as well. So there's your setup, Rob. Tell the listeners how they should interpret. Is this the time to buy EV makers on the downside, or is there trouble in paradise?
Well, I wouldn't say now's the time to buy it, but as a short seller, part of me is a little bit disappointed, because I've sort of been developing this thesis that Ford and GM were likely to go bankrupt if they went ahead with these plans. Because if you really think about it, there was all this yay, rah, rah EV stuff. But when you look at the finances of this, they were spending tens of billions of dollars of investment and vertically integrating in a way that they haven't since, the days of the original Henry Ford. And making all of that investment and taking on all of that risk, essentially to stay where they are, to replicate their existing position, to switch to a new technology that would then displace the other old stuff that they have. So even if you thought that they were capable of doing that, which probably they're not, what's the best case scenario? EVs grow like a weed, and they have a bunch of old depreciated crap sitting around and $50 billion of debt on their balance sheet today, plus whatever they have to take on to build out the capacity. So that was looking like a disaster for them, and it seems like this was the logical thing for them to do. So in that sense, I think they've de-risked their business quite a bit. They've made it less exciting because they're essentially acknowledging there's no growth. There's nothing to be particularly enthused about with Ford and GM right now. And a lot of that kind of narrative, the yay rah rah stuff, is now deflating as they recognize the limitations and the bottlenecks and all this sort of thing. So it's a tricky situation. Ford stock briefly went under $10 this week. And, some of that growth premium is coming out of it, to the extent you could call it a growth premium. A pivoting to the future premium is coming out of it. But I wouldn't say these are attractive companies, and I wouldn't buy them for our clients. But they're not really. They probably saved themselves from going bankrupt by doing this. So I'm a little disappointed in that regard.
The twisted mind of a short seller, ladies and gentlemen. But I know that one company that you do like, I know, is Toyota. And if you sort of juxtapose, the word is juxtapose. Thank you, Jacob. If you juxtapose Toyota's recent results with Ford, it's also pretty striking because Toyota had a great quarter. They talked about in their latest report that they were up in quarterly profit by quarterly sales rose 24% to roughly $75 billion. And I know some of that probably has to do with the weak yen, and maybe we should talk for a second about the strong dollar and what that does for a U.S. automaker or for U.S. companies in general, because it's yet another example of how the dollar status as a reserve currency is not necessarily good for the United States. Toyota also has not been at the forefront of EVs. Hybrids is really where they seem to be getting a lot of their best profit margin and things like that. But they're ramping up $8 billion of investment of their own in sort of scaling EV production, and they're selling something like triple the number of EVs this year that they did last year. So how do you square your pessimism with the U.S. automakers with Toyota looking nice and happy right now?
Well, there's a lot of issues there. The first is, I think we've said a few times on the pod that you look to Toyota and what they're doing, and that's probably a good gauge of the reality, because Toyota has shown itself very adroit at navigating big changes in technology over the years. One of the period in which Toyota rose to dominance was the period essentially in which cars went from being purely mechanical to being largely electrical and computer-driven machines. And they navigated that far better than their American competitors. And this is, I think, a similar sort of transition that we're seeing. I think we were praising Toyota a few months back and got some flack from people on Twitter and that sort of thing. But I think this is sort of playing out the way that maybe we foresaw in some ways. But yeah, I mean, Toyota has essentially taken more of a ambivalent or neutral approach. They have a portfolio of different energy technologies. They've been one of the biggest proponents, not just of EVs, which get all the limelight, but they're still exploring hydrogen, and not just hydrogen fuel cells, but also hydrogen combustion, which is a very different sort of technology. And it's not clear what is going to be used for what, but I think this series of events and the success of Toyota at the expense of some of their competitors really plays out one of your bigger theses that you've been speaking about from a geopolitical perspective, which is there's no one solution. It's going to be different solutions for different circumstances, different markets, different geographies, different end cases. And that's sort of the way it's playing out. So Toyota has this diversified portfolio. Their geographical markets are much more diversified. They're selling into different sorts of markets, different sorts of vehicle types, and that seems to be getting rewarded. Whereas big political proclamations and throwing all your chips all in on one technology is not.
See what you did there with the chips. At what point do you think that U.S. automakers go to the White House and say, hey, like, you have to do something about this weak yen? Like, the yen can't keep weakening here against the dollar, and these Japanese car makers are just, there's nothing we can do. Even if we had the best cars and the best technology in the world, they would still beat us because they can sell us car cheaper than we do. You can't really imagine that in the previous, globalization. Everybody wants to join the WTO era, but in this era where you've got semiconductor companies which are getting the CHIPS Act, and you've had multiple examples of companies in different industries going to the U.S. government saying, "Hey, open up Section 302 or whatever it is, investigations into Chinese dumping or to this, that, or the other thing, and you want to make things great in America again, great. We need protectionism to do it." Do you think that's in the realm of possibility, or is that just a little too pie in the sky?
I think the ship sailed on that quite a long time ago, at least from a Japanese standpoint. So if you look at Toyota or Honda today, they're servicing their U.S. markets largely from U.S.-based manufacturing or Mexico-based manufacturing, like the U.S. automakers are. So there's an element there where they're already here. They're not winning because of the yen. They're winning because they're just better. That's the truth. So that's a big factor. I think it's hard to even prove that that's some huge advantage. The second thing is just politically, I don't think there's the same hysteria or worries that you saw. Like, the last time the U.S. was able to really do this was during the Plaza Accord period of the early to mid 1980s. And the Plaza Accord was in 1985, where the U.S. Treasury Department basically went to Japan and said, "Hey, you better appreciate this yen, otherwise you're going to be in trouble." And they did, and didn't really do anything. Toyota continued to mop the floor with us. So I think that's sort of time dependent, and that ship has already sailed, as I said, in many ways. The China thing is much more politically charged and much more emotional. So Japan is in sort of an interesting place, I think, because the weak yen does give them an advantage. I mean, it depends on what sector of the economy you're talking about, because it disadvantages consumption, it advantages export, at least for a time until prices adjust. So I wouldn't overplay it, but I think they're in the catbird seat to some extent.
Yeah. Let's move on. We've been talking a lot about innovation and disruption right now, which is one of our main focuses, but it was a pretty busy week for us in macro, and our macro strategy is one where we can be silent for a couple of months even, then all of a sudden we feel good about stuff or we feel bad about stuff and put positions on respectively. And it was a pretty busy week for us. So tell the listeners a little bit about kind of what we did, and we can talk about the why behind it.
So we've been talking about opportunities arising from the breakout of the war. And some of those have coincided with opportunities arising from just the market selling off because of interest rate concerns and various other things. Like we said, the market has been in the hole and was looking for an opportunity to rally. And Jay Powell gave it one. So what we did in the macro strategy was some of the markets that we like the most that have been deeply oversold, some of which directly because of the war, some of which just collateral damage. We loaded up, and that's started, so far so good, knock on wood, but the markets that we've loaded up in have been some of the absolute leaders in this rip-roaring rally. So, this is both to pat ourselves on the back, because we'll look for every opportunity to do that because we're shameless self-promoters, but also to show that, this is, I think, a good approach to investing is you find something that is good, you wait for the opportunity when people are panicking or selling it for reasons that are not valid, and then you step in and, fill that oversold condition when things are out of favor temporarily. So that's sort of the approach that we've taken, and we can talk about the individual trades or countries because I think there's a big geopolitical element to it. But it's funny. Jacob gave a presentation to a group of of individual investors and this week, and we were preparing some materials showing some of our investments that we've made in trades. And I was preparing for you the chart of the Turkey trades that we've done over the last 2 years. And it was funny because I was showing every time we bought, and I said, oh, well, Jacob can point that each of these was some kind of crisis that turned out to be not a big deal. So it's funny how geopolitical investing in that context sometimes is just recognizing when stuff's just not a big deal.
Yeah, but also recognizing when stuff is a big deal, because there are people out there who say, oh, all you have to do with geopolitics is sell risk. Like it never actually ends up being that way. But the Turkey chart's an interesting example because we got the hell out of Turkey for around the election season because we were a little bit worried about the volatility around elections because we didn't know what was going to happen. And our worst case scenarios didn't pan out. Erdogan won, and there wasn't any civil conflict or anything like that. But like Turkish equities suffered from that volatility quite a bit for that 16-month period, and we didn't even have a position on during that period. So it's also identifying when things are bad. I think you're wrong. I don't think we're shameless self-promoters. I think we are shameful self-promoters, which means we feel terrible about it, but we still have to do it because we think that's what we're supposed to do in order to grow our business. I don't know about you. It ends me wanting to take lots of showers at the end of the day. Anyway, so we've talked a lot about Turkey. I think Saudi Arabia and Mexico might be newer for listeners. So I'll let you pick which one you want to talk about first. You want to start with the Saudis or start with the Mexicans?
Well, let's start with the Saudis because I think that's more directly tied. Like Mexico, we love Mexico, and it was overbought and got sold very heavily in sympathy with a lot of high beta assets, and we bought it. I don't know if there's much of a story that's more tactical around that, other than the longer term things that we've identified there.
I do want to say one thing about Mexico before we leave it. I mean, it's just that we're finally having transparency about who's running in the elections next year, and Claudia Sheinbaum is going to be Morena's choice, and she's going up against Galvez, whose first name I can't remember right this second, but she's representing all the other opposition parties together, and that's usually a bad sign when the opposition has to join together just to go after the one major party. But they're both women. They are both engineers or sort of scientists in their own way, and both fairly pragmatic. And Sheinbaum herself, I mean, yes, she is an AMLO protege, and she's definitely in Morena, and she definitely wants to increase Mexican state control over the economy, things like that. But if you were looking for a best case Morena candidate who was going to rein in some of AMLO's weirdness and excesses, but also somebody who was pragmatic and thinking about what was best for Mexico and Mexican industry, that's your candidate right there. I couldn't help but think about Angela Merkel in 2005, and I know that the latter half of Merkel's rule got sort of dirtied by I don't want to say wrong decisions, but maybe political missteps around migration in 2015-16, and some of how she dealt with the Russia-Ukraine. I mean, all those sorts of things. But if you look back at the full sort of scope of Angela Merkel's career, it was pretty good, and Germany did pretty amazing things, especially in the first couple of years of her rule. And she was a steady hand at the ship. You can see what the loss of the steady hand at the ship has done to German politics ever since she left. So Scheinbaum gives me sort of weird Angela Merkel vibes. Take that as you will. But anything else you want to say there? Or you want to move to the Saudis?
No, let's go a little bit more on Mexico because we gave a presentation on this recently, and I wonder if it's worth recapping at a high level, at least some of the big positives, but also some of the risks that we're watching out for with Mexico. Because I think we've talked up the positives a lot, but I don't think we've really talked about what we're watching for to see clouds potentially on the horizon.
Yeah, there's only one big major risk for me, and it might surprise listeners to know it has nothing to do with the cartels. It has to do with, is Morena going to win a supermajority in the next election? And if they do, are they going to start making changes to the Mexican Constitution that allows the Mexican government to treat other sectors of the economy like they treated Pemex in the 1960s and the 1970s? So if you go back to the 1960s and the 1970s, Mexico was a very state-driven economy, and they had a lot of oil, and the Mexican government basically just, sucked all of the profit and energy out of Pemex. And now you have Pemex, which is sitting there, like, I forget the exact figure for Pemex's debt. It's something ridiculous. And it's just not a really profitable company, and how it can get out from underneath that debt is is really unclear. So the bear case scenario is you get a Morena supermajority and you get the Mexican government looking at other industries, especially the manufacturing industry, which is where Mexico has its big example, and basically tries to use that Pemex treatment and say, okay, the state is going to intervene here. It's going to control things. It's going to tax things at a very high level so that it can redistribute income and reduce wealth inequality inside of Mexico, which has been significantly exacerbated by NAFTA and free trade and the USMCA. I think in the long run, those things will be good for Mexico, and it's created incredible wealth. But the first stages of globalization or of liberalization of trade in an economy always increase wealth inequality. And in some ways, Mexico is still at the beginning of that process. But that's the bear scenario. But balancing it is just that Mexico is where it is, and its geopolitical fundamentals are sort of locked in. The question then is just, are Mexican companies a good investment if the Mexican state can do that to them? But in terms of, interest in Mexico and the fundamentals, like it's a really good time to be Mexico. It's not very often in world history you can say that.
This is sort of off the cuff, but is there any, what I'm thinking of is, how does the success of Mexican manufacturing in the last, 5 to 7 years and the very visible success and the very visible FDI in that area actually increase the risk? So are there any examples, I'm trying to think, of governments that have sort of tried to increase the burden on a very overperforming part of the economy, in part because it's, hey, you guys are clearly doing very well and you have to share that. You understand what I'm trying to ask?
Yeah, wasn't that basically what Xi Jinping said to Tencent and Alibaba and all the rest of the Chinese tech companies 2-3 years ago?
Yeah, that's a good example, actually. So worth thinking about.
But the issue there is that, that was also it's hard to compare those things because that was also about political control. And now that Xi has control, he's now encouraging the tech companies to go back to printing money because he knows he needs the private market to churn. But I think that would be your example. But I would also just say, like, the Mexican manufacturing success story, it's still pretty early. Like, so much of the Mexican economy is still the informal economy and the gray economy. Yes, in a couple key areas and sectors, they've advanced in terms of manufacturing prowess, but there are other sectors where it's still small mom and pop shops that are doing stuff, and there's just not a lot of capacity. And either it's because of structural challenges, or they're in locations that are threatened by cartels or sort of other things. So I think one of the things that is so attractive about Mexico is it's early. It's not something that's established yet. It's also one of the things that is not attractive about Mexico for a foreign company, because unless you're in one of those sectors that have already been built up, you're probably literally building the roads and building the factories and training the workers and figuring out how to negotiate Mexican law and all these other things. Like you're breaking ground there in some ways.
So, Saudi, do you want to speak to the geopolitical and war-related aspects of that one?
It kills me because I've been so pessimistic about Saudi Arabia, and I still want to be pessimistic about Saudi Arabia, but it's getting harder and harder to be pessimistic about Saudi Arabia. Cousin Marco, you guys might remember, came on the podcast. God, that must have been 6 to 8 months ago now, and compared what was happening in Saudi Arabia to the Meiji Restoration in Japan. And I literally wanted to light myself on fire during the middle of the podcast because I just couldn't conscience the comparison. But look, like, oil was hanging out around 80 a barrel when we made that trade. It's around 83 right now. And it's just, we've been waiting for the other shoe to drop with the war. I still think the most likely scenario is there's not going to be a regional conflagration, or that Iran is not going to step in and try and jack up oil prices. Their calls for an embargo have gone on deaf ears. They'd have to do something in the Strait of Hormuz to affect oil markets in the way that would create a shock to the system. But I just can't believe that oil is going to stay this depressed, especially if the war continues to go on. And it looks to me like, Israel's not stopping in the Gaza Strip. Israel's very clearly going to take this to the very end, and they don't care what other countries tell them to do. I don't think they even really care about normalization with the Arab countries that they've achieved over the last couple of years. I think they would like to keep normalization, but if the price of them being able to achieve their geopolitical imperatives in Gaza means losing those relationships, I think you're seeing that they'll lose them. And so that puts us in a very difficult position for the Arab countries and how they're going to deal with Israel and how they're going to deal with the United States, which is backing Israel to the hilt. And all of that just means volatility probably in oil markets. Still, I think it's something like 30% of the world's oil that's consumed every day is coming out of the Persian Gulf. That number might be higher. So that's just the one that I remember off the top of my head when I was looking at this earlier this week. So you put all that together, rising oil prices should mean good things for Saudi Arabia in addition to everything else they're doing. But the reason I'm so tickled that they're doing well this week is because, as we said, oil's not doing anything this week and the Saudis are still doing well. So at least somebody out there is behind the Meiji Restoration talk, and I guess we are too.
Well, I wouldn't go that far on the Meiji Restoration, but I would add a few. There's a few things I want to talk about with Saudi. First, on the Meiji Restoration, I think on the surface that's a seductive comparison, but the one thing that separates something like, and I know Marco's sort of speaking in jest, but just for the sake of considering it seriously, the one thing that's different between what you saw in Japan and to a lesser extent what you saw in places like Korea or China when they were having their growth miracles and their catch-up growth, the word is discipline. And they had the right structures in place, the right bureaucratic structures to create the incentives, to give the support from the state to move up the value chain. But the companies that were wasteful and the companies that were not doing what they needed to do, they had set up this mechanism in a way that they would punish them and move the capital away from them and towards the companies that were doing the right things. And that's how they sort of accomplish that painstaking task of, increasing their export share and learning how to do things, and this whole concept of savoir-faire, knowing how to do stuff. That's the formula that they met. And I think as much as on the surface, Saudi appears to be trying to do some of those things, they're throwing massive amounts of money and trying to move up value chains. I think it's that lack of discipline that's the key element. And there's an institutional setup issue there, which, is kind of obvious just looking at how decisions are made there relative to how they were made in those other examples. But that, I think, is a really important thing. Anyone who's going to give Kalabu Koulibaly $20 million a year to play football, that's not a disciplined, the Japanese would never have done that. So that's on the Meiji Restoration thing. But
well, hold on. Weren't the Japanese buying up like Pebble Beach and other things in the United States at the peak of their bubble? I mean, they weren't immune to it. They just didn't care about the soccer that much.
That's true, but that was a little bit different. They were already on top of the world at that point. They weren't doing it in 1972. They were doing that in 1988, right before things went off the rails. And also, that was right, when they lowered interest rates. So, I mean, I don't want to talk about Japan. This is about Saudi Arabia, but, anyway. I'm about to nerd out on 80s Japanese economic history. We don't have to go there. But the thing about Saudi that I think is interesting, too, is as a play on oil, I mean, that said, I'm sort of being negative on Saudi, but in the near term, I think it's more positive because they are clearly going to invest a lot, and they are investing a lot. And the nice thing about Saudi is most of the most liquid equities and the biggest components of that index are banks. And banks do well when there's credit growth, when there's fixed asset investment. Their balance sheets expand. They look very profitable, even if they're hiding losses, under the rug that are going to show up later. And the benefit of all this, just from an oil perspective, it's not just, Saudi Aramco is in the index and they're going to do well. It's when the oil price goes up, everyone's credit quality improves in Saudi, and the bank fundamentals improve. So it's sort of this self-reinforcing thing. And if you think that oil prices are at least skewed upward, it's a nice way to get an extra exposure to that. That is a little more oblique, if that is clear.
It is, and it's also a play on, there are very few geopolitical truths out there, but one of them is if you have access to ample cheap energy, you can do pretty interesting things when it comes to industry, maybe even if you don't have discipline. So when Saudi Arabia threatens to become, they're not just about oil. They want to talk about hydrogen, and they want to talk about petrochem, and they want to talk about emerging in all these industries that are very, very energy intensive, where countries like a Germany are really struggling. Like, that is a place where they really could make a mark and take some market share, just using what they have and without having to do any of the mass cultural changes that Vision 2030 and everything else is talking about. So I do think there's opportunity in that context, how you use cheaper energy in general. I got to go put on a tie and talk to a group of investors and things like that. But the last thing I want to say before we leave, a lot of new developments in the Russia-Ukraine war, a lot of developments in Israel-Gaza. We will have multiple podcasts out next week on Israel-Gaza, by the way, and the Russia-Ukraine situation. You've got stuff on the Knowledge platform if you're a subscriber there. But don't lose sight of the rest of the world, and don't lose sight, especially of what happened in Asia this week. We talk about the Philippines and China a lot. I think the Philippines-China take that we have, namely that China's not spoiling for a fight right now, it's getting a real big stress test, because if you're China, now's the perfect time to test the United States. The United States is distracted. Its carrier battle groups are in the Mediterranean. It's got both Ukraine and Israel that it's supporting wars. It can't really afford a third one right now. So if China were ever going to test the United States on the Philippines, I think now is the time. There's been some pretty significant fighting in northern Myanmar this week, in Shan State, which is on the border with China. And China's even sort of talking to the military junta in Myanmar and trying to figure out what's going on. They've supported that junta since they took over in a coup a couple of years ago because they're enforcing stability. A lot of mineral resources in Myanmar that China takes advantage of. Tin is one of the big ones, but there are other things as well. Just something to keep an eye on here if we're going to get a major uptick in fighting there, especially if it means that the military junta is losing power in Myanmar. And then last but not least, Pakistan is telling over 1 million undocumented Afghans that have been living in Pakistan they have to go back to Afghanistan, and moving them forcibly to the border with Afghanistan and kicking them out of the country. And we're just beginning to see the videos of that process happening and how horrible it is. And maybe it just stays a horrible thing. But when you move 1 million people from one country to another, and that second country has a history of sort of scuttling plans in the global marketplace in ways that nobody expects, I don't know, my antennae were just up. So there are a lot of things happening out there outside of the wars, and I would tell listeners to maybe keep an eye on those 3 things. I'll certainly be keeping an eye on them over the course of the next 7 to 10 days. Anything else you want to talk about, Rob, before we say sayonara?
No, I think you have to put a tie on, and my novelist is waiting for me downstairs. So let's get on to.
Heaven forbid you should be late for the novelist. They told me to wear comfortable clothes for this presentation, and the thing is, I don't feel comfortable doing presentations if I'm not dressed up well. It's like I'm a medieval knight, except I need my armor on. But instead, it's November, so I get to take out my Christmas tree tie, which is great also for cognitive dissonance. Jacob Shapiro comes in with his Christmas tree tie, and nobody knows what to do. Anyway, I'm rambling. I'll see you later, Rob.
See ya.
Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.